Sup money masters, it's me SJ, hope you're all well. Today I'm kicking off the series on risk. I've mentioned it a few times in my previous videos and excited to start this today. This is risk part A, and in part A I'm going to show you the measure, a mathematical formula or measure that the savings and investment industry uses to tell you whether a product that's available for you to invest in is risky or not risky, or we can also say less risky. There's never no risk. There could be lower risk, but not no risk. And then I'm going to tell you that that is not something that you should be too bothered about. There are more important things that you have to keep in mind. And if you do that, then this way that the industry measures risk by becomes quite irrelevant, really. Let's rock and roll. Okay, let's go. When a financial advisor talks to you about your savings and investments, and or you hear something in the news when they talk about different products and the risk in those products, it all comes from something that we can summarize in a graph that is often shown to you as a client or a potential saver and investor. And that graph looks something like this. This is risk according to the industry. I'll show you this graph, and then often it will say risk and expected return. Expected return, not guaranteed return. There's no such thing. Okay, so what this graph tells you is the more risk you take, potentially your return is higher. So the more risk, the more expected return. Now let's look at the typical products that you will most likely be shown when you are presented with a graph like this, or when people talk about available products for investment and the risk they carry. You'll often see something like this. In the bottom corner, you'll find a cash product, lower risk, lower expected return. And then we'll move up the scale: income funds, absolute return funds, balanced multi-asset class, diversified portfolios or funds. Whoo's fancy language. And usually right at the top, you'll find the equity fund. Whoa. On this graph, that looks like it's very risky. Why? Because it's the last one we see. Right at the top there, high risk, higher expected return, but remember, it's not guaranteed return. And here we find one of the first problems already, in my opinion. The graph stops at the equity block. Now, if I mentioned the word funds and products and investments, I will explain in a later video what is a unit trust. It's also called mutual funds. I will explain that in a different video. But for now, just think about this graph and what the blocks I showed you as different products that's available for you for investment. And the reason that graph stops at equity is because of regulation. There are many other things that you can invest in, but by regulation, these unit trust or mutual funds are not necessarily always allowed to invest in those other more risky products. And now they stop the graph there, and you think that block is very risky because it's the last one that they show. I'm going to go back to that graph and just show you what else could be on that graph that's not necessarily available in the unit trust or mutual fund format, and not necessarily or always available for you as a private individual to invest in. So if we go back there, over here you'll find things like private equity investments, venture capital investments, and then one that you may not have thought about, your own business, right there at the top. So why do I say that is risky? I'll give you a scenario. You've been mastering your money and you've gathered or saved 70% of the money you need to start your own business. You borrow the other 30% from the bank, start your business, it's going well, and it's awesome. Then, as an example, unexpectedly something like COVID happens. businesses shut down, and it unfortunately in this scenario leads to your business going under. Your 70% of your money that you saved, gone. Now you've got to find a job to earn an income because the bank wants their 30% back, plus interest. So can you see how that is quite risky? You can lose in that scenario all your money and you still owe. Now, just to be very clear, I'm not saying don't start your own business. It's one of the best ways to generate income and grow your savings and investments. Remember, it is right there at the top. Higher risk, but potentially much higher return. So if you've got a great business plan, go for it. I'm just saying that relative to the things that we usually see on the graph, there are other things that are a lot more risky. But now we sit with the mindset that that equity block is extremely risky. And now I'm going to go into the measure that the industry uses that determines why that equity block is right at the top on this type of graph usually, and why the other ones by default then fall into the lower risk, lower expected return category. Let's get back to that graph. So the question is, why is this one down here and why is the equity block up here? What is the measure, the way that the industry determines that this one is down here, the cash, and the equity is up there? And that measure is called volatility of returns. Oh, that's hectic words. I'm going to explain that, don't worry. So the word volatility probably already gave it away. But just for clarity, if something moves like this, it's a lot less volatile than something that moves like this. And that volatility of returns is a mathematical formula that they use, and they take the returns of, in this case, the cash product or fund and the equity fund. And what they do is they calculate mathematically the volatility of the returns of those products. And cash, you earn a little bit of interest every month. It doesn't change a lot, so it is a lot less volatile. Whereas the equity fund, the returns in there, 1 month plus 10, the other month plus 2, the other month minus 3, plus 1, minus 4, plus 3, minus 1, and so it goes on. And did you hear that I just had minuses in there? So the volatility of returns of the equity funds or products are much higher. And then on that graph, let's just have a look at that graph again. So that mathematically calculated formula of volatility of returns, then the output of that, or the answer to that mathematical formula, shows you or tells you that this block has got a lower volatility of return than this block. This one's got a higher volatility of return than this one. This one's got a higher volatility than this one, and you end up at the equity fund, which most often has the highest volatility of returns. And that is why you see this progression from the bottom to the top. It's all based on a mathematical formula that calculates the volatility of returns of those products. Now remember, in the beginning I said I don't think that this is so important. This is not the main thing that you should be looking at as a saver and somebody that wants to take their savings and start investing it. It doesn't play no role, but it doesn't play the primary role. And that is the problem I have with the way risk is measured and talked about in the savings and investment industry. So let me show you a real life example, South African based example, South African asset manager. They have a long-term track record, they're good at what they do, and I just took their fact sheets. That's information on these funds that's publicly available. And I'm first going to show you, if you invested 10,000 bucks with them 10 years ago, up to the period leading to end of October 2022, which was the latest available information when I made this video, what that looks like, and does the volatility of returns play a role? So let's have a look at that. So over the last 10 years, I invested 10,000 bucks. The equity product gave me a 9.1% return. The cash product gave me a 6.5% return. My 10,000 would have grown to 23,000 in this case, and my 10,000 would have grown to 18,700 if I invested in cash. And interestingly, both products, the low risk one even, outperformed inflation. Remember, if you don't understand this, please go and check out specifically inflation part B that I did earlier. That will help you explain why I say both of them outperformed inflation and why that's important. So in both cases, your money would have grown in excess of inflation. Your purchasing power of your money is still higher. Awesome story. Exactly right. And you may say to me, but there's no problem with volatility, that you explained it. We invested, the higher risk product gave us the higher expected return, and the low risk product gave us also actually a good return in excess of inflation. It was just lower than the higher risk. Everything looks fine and dandy. Okay, let's take the same information, but instead of over the last 10 years, we'll do it over 5 years, ending at the end of October 2022. Now, what does that look like? Now you can already see this splash of red here. The higher risk product barely outperformed inflation, so at least your purchasing power of your money kept up with inflation, but it underperformed the low risk product here. Your 10,000 over the last 5 years would have grown to 12,800, and in this case of the lower risk product to 13,600. So now you can start seeing that this volatility of return, this riskiness that's measured by the industry, it does play a role, because the higher risk product with more uncertainty, higher volatility, more uncertainty, in this case, it didn't deliver what was expected. And yet, I keep telling you that this is only secondary to what you must be thinking about risk. So let me show you what I believe your biggest risks are. And once you've got those under control and understand those risks, you can then start worrying about the volatility of returns. Apologies for the photobomb. That, as many of you will know, is how we roll when we live at work. Double espresso to get me back on track. Okay, what's your biggest risk? Your biggest risk is losing money. We hate losing money. And in the next video, part B of risk, I'm going to explain why we don't like it and what the mindsets are, the psychology behind this, so that you can understand it better and make better decisions about the risk you're going to take. But how can you lose money? What's the risk of losing money? What increases the risk of losing money? The first thing is doing nothing. Yeah, you have to take some risk to make money. You can't take no risk. There is no such thing as no risk. Doing nothing is one of the biggest risks, because it's guaranteed when there's inflation, like there is around the world at the moment, that the purchasing power of your money is going to get less. Go and check out that inflation part B video that I mentioned earlier again. That will explain this a lot better. The other way you can lose money is by having the wrong time horizon. In capital letters, screaming out at you. I just showed you that real life example. Over 10 years, fine and dandy, sprinkle some fairy dust on there, everything looks great. Over 5 years, a different story. So that brings us to the next thing that you have to consider very carefully when you want to start investing, and investing means taking risk. So the next thing you have to consider is, what are you saving for? This is a risk factor, because you have to be able to answer that question clearly. There's a big difference between, let's assume you're a young person and you want to save for your retirement, which may be 2, 3 or 4 of these 10-year periods, in other words, 2, 3 or 4 decades away, in which case you can take higher risk, because there's volatility of returns, as I've showed you in the longer term example, that doesn't matter so much. Relative to you, I'm saving for a deposit on a vehicle, or I want to get married, or I want to start a family and there's medical costs involved, or there's something I want to buy in the next 2 or 3 or 4 years. Okay? Once you've answered that question about what am I saving for, and therefore what is my time horizon for when I need the money for what I'm saving for, your next big risk factor is expectations. Expectations. You can't expect with a short-term time horizon to go and invest in a massively risky product and get the returns, because that's not how it works. I said volatility of returns is secondary, but you answer these risk questions that determine your risk framework first, and then you've got to go and see, okay, what can I expect for this time horizon, for what I'm saving for? What should my expectations be? And Warren Buffett's got a great quote. He says, the secret to great investing is the same as the secret to a happy marriage, which is start with low expectations. Okay, so manage your expectations. And I will talk more about that in the risk part B video as well. And the last thing that you cannot account for is surprises. Surprise! Okay? You cannot account for that. That is why you've got to answer these first questions, or the questions that I mentioned already first, to determine your framework, because inevitably there's going to be a surprise. So you have to have the right what am I saving for, the time horizon I'm saving for, the expectations for what I'm investing in, and then you have to know that there will be surprises along the way. In the beginning of 2020, when COVID hit, we had the biggest, severest bear market in the history of markets ever. Surprise. And also a surprise, but a positive one, we had the fastest, quickest recovery after the bear market in 2020 as well. And now in 2022, the markets have gone down again. So there will be these surprises along the way. And in part B of risk, I will give you a couple of numbers as well to prepare you for the type of surprises and the severity of those surprises that you can expect. Now, I think I've run out of time a little bit. I did mention in the beginning of this video some interesting numbers. I'm going to leave that over for part B, and part B will be airing shortly. I'll prepare that video quickly and you'll be able to see what those numbers are. So, let's conclude and summarize. Your biggest risk is losing money. The way you can lose money is by doing nothing, having the wrong time horizon, not sure what you are saving for, so therefore you don't know how to determine your time horizon, your expectations about the investments you're making, and surprises. There you have it. Those are your biggest risk factors. You have to be able to answer these questions and know that even when you've answered them, there's going to be surprises. And then when you've answered them, then you can see what product I can invest in or should invest in, and that you can then use that secondary important risk factor, the volatility of returns, to help you decide and to help you prepare for what to expect from that type of investment depending on the volatility of returns. Thank you for joining me for this video. I look forward to seeing you in the next one, which is in this case the one I recommend, Risk Part B. Remember to like and subscribe, and I'll see you in the next one. Cheers.